The power of bond investing. A balanced approach. Imagine if you could secure your financial future with a strategy that promises both stability and growth. A strategy that the world's wealthiest investors rely on to balance their portfolios. Stay with us, and we'll reveal the secrets of bond investing and how it can provide you with a balanced approach to financial success. Welcome to Nouveau Riche Investor. Today, we delve into the powerful world of bond investing. We'll uncover the basics of bond investing, explore how bonds fit into a balanced portfolio, and show you how this strategy can lead to long-term financial security. Benjamin Graham, the father of value investing, emphasized the importance of a balanced portfolio. One of the key components of this balance is bond investing. But what exactly are bonds, and why are they crucial for your investment strategy? Bonds are essentially loans that you, the investor, make to corporations or governments. In return, they promise to pay you regular interest and return your principal at maturity. Unlike stocks, which offer ownership in a company, bonds provide fixed income and are considered less risky. Let's break down the basics of bond investing. Bonds can be categorized into various types, including government bonds, corporate bonds, and municipal bonds. Each type has its unique features and risk levels. Government bonds, issued by national governments and considered very low risk. Examples include US Treasury bonds, corporate bonds, issued by companies to raise capital. These come with higher risk and higher returns compared to government bonds. Municipal bonds, issued by local governments or municipalities. These bonds often provide tax-free interest income. Suppose you invest in a corporate bond with a face value of $1,000, a coupon rate of 5%, and a maturity of 10 years. This means you'll receive $50 annually for 10 years and get your $1,000 back at the end of the term. This predictable income stream is what makes bonds a safe haven for many investors. But why are bonds essential in a balanced portfolio? The answer lies in diversification. A well-diversified portfolio includes a mix of asset classes, stocks, bonds, and other investments. Bonds provide stability and reduce the overall risk of your portfolio, especially during market downturns. Imagine navigating a stormy sea with a sturdy ship. That's what bonds do for your investment portfolio. They act as a stabilizing force, ensuring steady progress even when the market gets rough. In conclusion, understanding the basics of bond investing and incorporating them into your portfolio is crucial for long-term financial success. Bonds offer predictable income, lower risk, and essential diversification. By following these principles, you can build a balanced portfolio that not only survives market fluctuations, but also grows steadily. For a deeper dive into these principles, I highly recommend reading The Intelligent Investor. Stay tuned for more videos where we'll explore each of these concepts in detail. Until then, happy investing.